You're welcome back. Let's continue from the previous solution. Now we have our goodwill account. Remember, I told you goodwill is when the new value of a business or the revalued amount or the new worth of a business when it is higher than the net asset of that business or the carrying amount of its assets and liabilities. When the new worth of the business is higher than its carrying amount or the net asset, then the business will have a goodwill. Now, goodwill is not recognized or recorded in the books of account of the business or of any business unless the business has been purchased by another business. Goodwill is more pronounced in financial reporting under business combination, specifically for consolidated financial statement. You will learn more about goodwill under that. However, why are we then looking at a goodwill account? The reason why we have to open a goodwill account is to determine the portion of the 25,000, meaning the capital that was paid by B. The 25,000 that was paid by B as capital, what portion of it represent payment for the share of B in the goodwill of the partnership? How much will he have of the goodwill and how much is he paying for it? It's just for us to determine how much is the new partner paying for his own share of goodwill, because since he is now a member, he will have to have a share of the goodwill. That is why we want to open a goodwill account. So let's see what I'm saying. Let's see it. Now, firstly, the goodwill from the question is 12,000. This goodwill, as it is now, belongs to the old partners, that is A and C. Therefore, it will be shared in their old profit sharing ratio. Since goodwill is an asset, we will debit the goodwill account and we will credit the partner's capital account to increase their capital account with their share of goodwill. That is it. So let's do that. So share of goodwill in old profit sharing ratio. A, we get 3/5. Okay, which is 3 over 5 multiplied by 12,000. Okay, and that gives 7,200. Why C, we get 2/5, which is 2 over 5 multiplied by 12,000. Okay, and that gives 4,800. Now, this same goodwill of 10,000 will now be shared in the new profit sharing ratio, now that we have a new partner, which is B. And to do that, we will credit the goodwill account and we will debit the partner's capital account with the new share of goodwill. You see, by crediting the goodwill account, it will represent two purposes. One, it will close the goodwill account because the goodwill account will be closed out completely. 2, we will now determine how much B is paying for his own share of goodwill. Now let's see that. So share of goodwill in new profit sharing ratio. A will get 1/2 of 12,000, which is 1 over 2 multiplied by 12,000, and that's 6,000 based on the new profit sharing ratio as given. C will get 1/3, which is 1 over 3 multiplied by 12,000, which is 4,000. And B will get 1 over 6 multiplied by 12,000, and that's 2,000. Okay, now let's look at it together. Initially, A has 7,200, but now we have removed 6,000. Okay, that means he has 1,200 left as goodwill. Hold that for now. C has 4,800, but now we have removed 4,000. So he has 800 left. So together, he has 1,200 left as goodwill. C has 800 left as goodwill, making 2,000. That 2,000 they are having left is as a result of what B has paid of 2,000. Therefore, B is invariably paying for his own share of goodwill to the old partners. Therefore, in the future, when they are sharing goodwill, we will know that B will have 2,000 of that goodwill. And that is the aim of having a goodwill account in the partnership books. In the next video, we will look at the next requirement of this question, which is to open the partner's capital account. Thank you very much. See you in the next video.